Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have the CEO, Jeff Schellenberg from Decisive Dividend. Decisive Dividend trades on the TSX Venture Exchange under the symbol DE, and it also trades on the OTC under DEDVF. The company is currently trading just off a 52-week high at $8.90, with about 18 million shares outstanding, or about $155 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks a lot, Trevor. Yeah, great to have Jeff here today. Decisive Dividend is a company that I'd say we stumbled on, about 6-7 months ago, but presented it to our audience about 3 months ago when it was a little bit cheaper. But since then, the stock's really had a good run. So we thought it'd be great to have Jeff join us. Tell us all about the company and, ideally tell us about what the potential future looks like. So Jeff, you've got a presentation. I'm going to hand it over to you and let you go.
Excellent. Awesome. Thanks very much, both Trevor and Paul, for setting this up. Look forward to the conversation today. So like they said, my name is Jeff Schellenberg. I'm the CEO of Decisive Dividend. I've been with Decisive for about 2 years at this point in time. Prior to that, I ran an energy services business out of Edmonton. I was co-CEO and CFO of that business, so I had an operational background of 7 years in that entity. And then prior to that, I was an investment banker and lawyer. So I had in Toronto on Bay Street with Merrill Lynch and a law firm called Davies, Ward, Phillips and Weinberg. So I had a transactional experiences at the very formative early stages of my career, and then moved into an operational role, which obviously very different than professional services, but both of those experiences very relevant for what we have going on here at Decisive Dividend. We're an acquisition-oriented company that looks to acquire manufacturing businesses and then grow them over time through enhanced operational capacity. So that's kind of a little bit of background on myself. But what I'd like to start this conversation with is really the primary catalyst for this business, which is really driven out of kind of the aging demographics and intergenerational wealth transfer periods that really the Western world is engaged in. And the statistics in Canada are actually pretty startling. There's some recent work that's been done by a variety of research institutes around this particular topic, but the CFIB put out a report very recently talking about the tsunami of businesses that are going to be for sale over the next 10 or so years, driven by this dynamic of an aging demographic. And the statistics are that the CFIB reported are that 76% of Canadian businesses or Canadian business owners are going to look to exit their business in the next 10 years. And this represents over $2 trillion in asset value. And so there are a remarkable number of opportunities in the marketplace even today, driven on the back of this particular trend. And so it's something that we really think this vehicle, Decisive Dividend, is uniquely positioned to take advantage of that trend in a way that really aligns with a lot of the concerns that these exiting legacy-minded business owners have. So we'll talk about that throughout our presentation. I have a slide deck on. This is our investor pres that's currently posted. So I'll begin to flip through that. So as I mentioned, we look to acquire well-established, high-quality manufacturing businesses with enterprise values up to $25 million. We then look to build and hold these businesses. And so I'll talk about why these are important, especially in terms of how we as a buyer differentiate ourselves from in a world where there's been a tremendous amount of capital raised to fund acquisitions. Obviously, capital is becoming more expensive, but especially in private equity markets, a tremendous amount of capital has been raised over the last 3-4 years. So how do we compete for deals? Well, when we talk about these 76% of business owners that are looking to sell their businesses, the number one concern, the primary concern that 90% of these business owners talk about when they're as what their concerns are when thinking about exit is that employees maintain their jobs. And that's straight out of the CFIB report as well. And that for us, and another key primary focus of theirs, they talk about the business model kind of carrying on, or their business legacy continuing as a primary concern of theirs as well. And our business model really deals with or addresses these two primary concerns very directly, in that, what we're looking for, the type of vendor we're looking for, is what we call an exiting legacy-minded business owner, a business owner that cares about these types of things. Because what we do when we acquire the business is we hold it for the long term. That's the hold element of this buy, build, and hold slide. We are not like traditional private equity that will own the business for 3 to 5 years and then look to flip it to earn their shareholders a return on their investment or crystallize that return for them. Rather, we hold these businesses for the long term. We utilize the cash these businesses generate to pay a dividend to our shareholders, and then we're publicly traded, so our investors can sell the shares, their shares if they want to, on the open market to crystallize their return. So that whole piece is really meaningful to these legacy-minded exiting business owners that I've talked about, because it doesn't introduce kind of a second stage risk of, we as a private equity player own it for 3 to 5 years and sell it at a later point, reintroducing this element of what's going to happen to the employees in this business. No, we hold these businesses for the long term. We've never sold a business. We bought our first business in 2015, and we hold them for the long term. And that really differentiates us and is a primary reason why people choose to sell their businesses to us. The other element that is really meaningful, and I think an important part of our return profile for our shareholders, is the build element of our model, where we look to support the long-term success of the businesses we acquire with different types of support. It would be strategic planning or operational support or capital investment. The opportunity within our subsidiaries to grow organically, kind of creating yards after catch, so to speak, for our investor base, is really meaningful and important. And I think we've proven some good results around that. In 2022, our subsidiaries had 30% organic growth. In the first quarter of 2023, they had 22% organic growth. Which I think is a tremendous opportunity for investors to earn a return on these businesses post our acquisition of them, even though we buy at really attractive multiples. So that's a bit of an overview of kind of our key differentiators and why Decisive, what our business model is all about. And that touches on a lot of points that are on this slide as well. Our model provides great opportunities for vendors. As an exit opportunity. By the way, we acquire 100% of the businesses we own, so there's no, our balance sheet is quite simple from that perspective. We don't have any non-controlling interests or anything of that sort, but we do require that they take a minimum of 10% of the consideration we pay them back in the form of Decisive dividend stock. And so that's a key element to aligning our interests with theirs. So those are some of the benefits for vendors, in addition to the ones we've talked about already. Employees, for them, it's business as usual. There's a sense of stability when a buyer like us comes along to buy the business, but they also get to participate in things like employee share purchase plans, which, when they've been part of a private company, is maybe not something that they've had access to. And then from a shareholder perspective, what we talk about is our story of growth and yield. And so we've bought 11 businesses in the first 8 years of our operation, but we've completed 6 acquisitions in the last 15 months, and Paul was referencing a movement in our share price, and that's really been driven on the back of pretty significant growth through both acquisition and organic growth that our portfolio of businesses has experienced, or as our portfolio has grown as well. And you can see all the financial metrics on this page about how our business has grown over time, and pretty significant cumulative annual growth rates that we've experienced across a variety of metrics. But what we're really primarily focused on is I highlight the chart in the top right-hand corner of this page, which is our growth of our financial metrics on a per share basis. If we're going to be creating value for our shareholders, which is a primary focus of ours here at Decisive, we need to be seeing enhanced financial metrics on a per share basis. We have a dividend paying model. We'll talk about yield in a second, but in order to increase our dividends, to drive capital appreciation in our shares as well, we need to see the revenue, free cash flow, earnings, EBITDA per share grow in the type of trajectory you see in this chart. That if these lines shift directions or start to go down, I don't imagine our share price is going to keep going up, right? Like these are value creation metrics, and really important that are a primary focus for us as we think about how we pay for acquisitions, how we fund acquisitions, and all those types of things. We need to be doing accretive deals, and then we need to be driving organic growth in the businesses after we acquire them as well. And that's I guess what this chart illustrates is it is what we're doing right now. So that's on the growth side. On the yield side, yield is a critical part of the story. We are a dividend paying model. We've paid out $23 million in dividends since 2015. In Q1, our trailing 12-month payout ratio was 58%. We've increased our dividend twice in 2023 thus far. We last increased it. We announced an increase in June, taking effect here in August, up to 4 cents per share per month. So that's just around a 6% yield based on where we're trading at today. So that is really a critical part of the story as well, and has been a key stabilizing force, I would say, in our business and in our share price over last year the period of volatility we've been experiencing in the markets here recently. This slide outlines some of our acquisition philosophy, and I won't spend a lot of time on that. I've touched on a number of these points already. Obviously, the size of business we look to is up to a $25 million enterprise value, and we acquire 100% ownership of these businesses. And so I think the key points I've already highlighted on these slides. The next slide highlights some of the businesses in our portfolio already, as well as some kind of key metrics that we are key KPIs that we look at in terms of how we think about acquisitions. So when we acquire businesses, number one, we're looking to acquire profitable, well-established companies with strong cash flow. We're not looking to buy turnaround type of stories or anything of that nature. We really want to buy businesses that are profitable and contributors to our cash flow profile, so we can utilize the cash flows of these businesses to help increase our share price. Secondly, the way we think about funding these acquisitions, I talked a little earlier about the fact that we require that a minimum of 10% of our consideration is back to the vendors in the form of shares. But we fund from an overall funding mix. We look to fund our deals on a 50-50 basis, 50% equity and 50% debt. And you can see in the little blue boxes under the logos that each individual acquisition has been funded in a slightly different manner. But on an overall basis, after 11 acquisitions, we're almost exactly 50% debt and 50% equity. We're currently sitting at 52% debt and 48% equity. And so that's what we're trying to do as we structure ourselves in that way, is to create leverage returns for our shareholders while managing the level of risk in the business by issuing equity to ensure that we're well on side of our covenant and have a really strong balance sheet. And I think that's exactly the position we're in right now. So that's the overall kind of couple of highlights around the acquisition philosophy side of things that I'd highlight on this slide. But in terms of the companies that are on this slide, we report in two different segments. We have a finished product segment that the companies here on this page are members of, and then we have a component part manufacturing segment as well, which I'll focus on the next slide. So in terms of finished products, we have 5 businesses in this segment currently. We just added another one here recently in a couple of weeks ago that I'll talk about here in a second. But in terms of the makeup of this part of the profile, we have a couple of hearth manufacturing businesses in Blaze King and ACR. One operates in the North American market, one operates in the UK and Europe. We have an agricultural and industrial wastewater management product business, that Slimline, that we acquired in 2018. We have a retail merchandising product and display products for consumer packaged goods customers business that's called Marketing Impact, that we acquired in 2022. And then we have a road maintenance and construction equipment manufacturing business called Capital I that we bought in April of 2023. So these are the 5 businesses that are part of our finished product segment. From a component manufacturing segment, we have the 5 businesses listed here. Unicast produces wear parts for the mining, cement, and aggregate industry. Hawk produces downhole fracking tools for the oil and gas industry, as well as other types of machined parts. Northside manufactures parts and equipment for commercial vehicles in the forestry and mining sector. Micon manufactures seals and grommets for heavy industrial equipment for use in the mining, oil and gas, and road construction industries. And Procore manufactures radiators that are aftermarket radiators that are used in the mining, oil and gas, and road construction industry as well. So what we have a growing expertise is in a group of really attractive steel manufactured products and some rubber and plastic manufactured products businesses as well. And really excited to see the overlap that's forming between these businesses, both in terms of the types of products and the types of materials these products are produced out of, that are providing opportunities for operational types of cost management synergies in terms of how we procure goods and those types of things to support the manufacture of these products, but also in terms of the types of customers that we sell these products into. We're getting a great group of products that gets is used by mining clients as an example, and so we're seeing some opportunities for overlap in that sector as well. This slide just talks about the most recent acquisition we did. We just closed it here a couple of weeks ago and in July, and so this was we were really excited about this acquisition because it was a further opportunity in the agricultural space, but also it's another plastic manufactured product that we have into the portfolio. And so I can talk a little bit about the business, but I think there's a couple of points that are important to illustrate here as well. What we do when we acquire these businesses, it's really important for us that we are very disciplined around the values we pay for this business, and that we do it on the basis of what the businesses have actually delivered in terms of results, not based on kind of any sort of forward-looking projections. And so, what we were able to do in this acquisition is buy this business at just over a 5x multiple, which is important for us from, like I said, from a accretive value creation standpoint, that those financial metrics per share, we need to buy well to be able to continue to drive those. But at the same time, we need to incentivize the vendors of businesses to sell to us, and there is definitely a financial consideration around that for them. And so that balancing act is something that we walk through and think we struck a really good balance with this deal as well, along with the other deals that we acquire as well. We're about a 3.5 to 5.5 times historical EBITDA acquirer. And so that's an important part of our story for sure. As you can see, this deal was obviously accretive to our shareholders, and you can see some in the second bullet some of the metrics that in terms of how we measure accretion. But the increase on an adjusted EBITDA per share basis of 19% was something we were really pleased with in this deal. And so it's a further example of a specialized high margin product that we were able to add to the portfolio in an industry that we're already in terms of the agricultural sector. So a tremendous deal for us. I'll touch briefly on this as well. This is an overview of kind of our balance sheet and capital structure. I know Trevor mentioned this at the start of the call as well, but we have about 17.8 million shares outstanding. Insiders own about 10.7% of that. We have the 4 cent a share per month dividend for just over 6% yield. We have about $45 million of debt outstanding. Pro forma for the most recent acquisition, we have $29.4 million of EBITDA. So obviously from a leverage perspective, we're in a really attractively levered position as well, with lots of capacity under our covenants as well, which is important as we look to fund additional acquisitions in the future also. In terms of our balance sheet, this slide illustrates our current lending facilities. We have our lenders, Canadian Western Bank. We have a 3-year term facility with them, and with 3 components to it: a fixed rate, non-amortizing term loan, and then 2 revolving credit facilities, which consist of a $15 million operating line and $25 million acquisition line. And for us, having our capacity to fund, always be in a position to fund our next deal, our next M&A deal, is something that's of real priority to us. And given the amount of available capital we have, we would be in a position to have done any of the deals that we've done up to this point in time, which is important as well. couple more slides here, and then we'll open it up to Q&A. This slide just further illustrates, the fact that we're a dividend paying model. We've done the recent increases to our dividend, but over time, cumulatively, we've paid $2.39 a share in dividends to our shareholders. This slide illustrates our financial results for in Q1 2023. We had a 72% increase in revenue, which reflects strong demand being experienced in each of our businesses relative to a year ago, as well as contributions from 2 of our acquisitions that we added during this time period. The other element we'd highlight in here is that our revenue growth really drove strong gross profit margins as well, with Q1 gross profit margin increasing 3% from 33% in 2022 to 36%. Likewise, we saw significant growth in EBITDA, as illustrated on this chart, which increased 14 cents per share on a year-over-year basis, which is an important metric for us to consider. And we see a lot of the same dynamics on our year-over-year results in fiscal year 2022. I'll wrap up with this slide because another key element of our overall model is diversification, and you can see on this slide how, based on the pie in the top right hand part of the slide, and we're diversified across a number of different industries, but also you can see from the map how we're diversified across a number of different geographies. And this just reflects our Q1 trailing 12-month results, and doesn't include the addition of 4 businesses since then, which provide further geographic diversification to our portfolio as well as to our sales by product type. And so what we're doing is building a diversified and stable series of manufacturing businesses that support cash flow generation, that allow us to maintain and grow the dividend that we have set, which we also believe, along with the growth profile of our businesses and our ability to acquire them, generates tremendous returns for our shareholders. And so with that, I'll pause and turn it back to Paul.
Perfect. Thanks so much, Jeff. I want to remind everybody, by the way, if you've got a question you'd like me to ask Jeff, just use the chat function you'll see down the button below, and then I'll do my best to ask a question. Lots of acquisitions in sort of last couple of years. Quick question right off the top is, like, how do you find the deals? What does your deal flow process look like?
Yeah, for sure. Yeah, I think there's really 3 ways we source deals. We could talk a little bit about each of them, but I think what we were really focused on when I came on board, we added a corporate development manager just a couple months prior to my arrival as well, a gentleman by the name of Tyler Sampson. Tyler does a tremendous job for us in generating deal flow. But the key for us as we were rebuilding kind of our pipeline of deal opportunities in 2021 was ensuring that we were in front of businesses that were for sale. And so we've been very active in broker channels, for example, both the accounting firms, but also different regional M&A brokers that have kind of these different local businesses for sale. And that for us is something that really is a key source of deal flow, and network that we were highly focused on and developing relationships in. And so we've seen a number of our deals come out of that. But in addition to that, we have a strong referral network, both from our executive team, but also our board of directors. And that's something that has generated a number of deal opportunities of acquisitions that we've done. But finally, the other element of what we've done and had some good success around is we'll go direct to owners for industries or segments that we're keenly interested in. We'll reach out directly to owners and look to initiate a dialogue with them. And with our business model, this buy, build, and hold business model, for a certain type of what we call that exiting legacy-minded business owner, our model really appeals to them. And so, once we have those kind of screening type of conversations, we can understand pretty quickly if that business owner is interested in our type of model. And that then leads to moving through the deal process with them. So yeah, it's really those kind of 3 sources, Paul, that generate the opportunities for us on the M&A side.
Now, it sounds like you do a bit of top-down selection. You're looking for specific industries or maybe specific companies to fit in. Is that more the case, or are you sort of waiting and seeing what's available out there?
Yeah, so I'd say it's a little bit of a combination of both. I mean, we can tell different stories about how we found different businesses. You know, I think, for instance, our hearth industry, we've added a company in October 2023 called ACR, based out of the UK, that we added to the portfolio, and that came to us because the vendors of the business were aware of the Blaze King brand, which is our North American product. And they instructed the brokers that were running their process to reach out to us to see if we would be interested in buying them, given their knowledge of the product. And Blaze King has tremendous brand recognition and brand equity. And so in that combustion world, you know, it's a well-known name. And so they reached out to us. And so that was pretty interesting for us, because we weren't necessarily focused on expanding into the UK and Europe in terms of an acquisition, but what we were focused on was finding ways to help Blaze King grow itself organically, to take it, you know, position itself in different markets, given the quality of the products it produces. And so this really helped us accelerate our growth into a different region. And that was basically came to us through an inbound reach out because of the knowledge of the product we have. So we are absolutely focused on adding on to the industries that we currently operate in. That's an example of doing something like that. But you know, in the wear parts space, for instance, we have different types of wear parts that we're in already. We have kind of the crushing, not the equipment itself, but the wear components for crushing equipment for use in mining and aggregate industries. We have, you know, the seals and grommets that we produce for heavy industrial heat exchange equipment, and the radiator products as well. Well, these parts wear out and have to be replaced regularly. You know, for a dividend paying model, recurring streams of revenue, you know, are a tremendous fit for that monthly dividend paying model. And so you know, that's an area we'd love to add more products, you know, businesses and products to. Likewise on the cultural side of the equation, as illustrated by the IHT acquisition we did here in July. That's another space that we'd love to add more products in. So yeah, we're absolutely focused on, you know, adding kind of within the industries we are, the types of products we manufacture, as well as the industries we sell into. But you know, it really will be also driven by the types of businesses that are for sale in these spaces that give us the opportunity to add in these areas.
I mean, when I first looked at you guys, I saw what appeared to be a bunch of disparate businesses, but it does seem that you guys are starting to find some synergies between your different acquisitions, and probably even leaning towards acquisitions that could create more synergies for you guys. Is that a fair statement?
Absolutely. You know, I've talked about the Blaze King and ACR stories. You know, what we're excited about what they're doing around developing a product that utilizes the Blaze King technology to be able to sell into the European market. You know, Blaze King has this high efficiency, like extremely low emissions. You know, the number one and number two most efficient wood burning stoves in North America they already produce, which is really a high standard that meets a lot of the global standards as well. And so utilizing that technology into a design, or developing that technology into design that fits the European market, is something that they're, you know, well on their way around, and so excited about the synergy opportunities there. But we also see an opportunity within our other subsidiaries. So for instance, Northside, who's a steel and aluminum manufacturing business that we have that produces a lot of parts for OEM equipment manufacturers, is currently and just has started producing stoves for Blaze King, given the demand for that product. And so you know, examples like that are significant. We're utilizing some of the sales force from our Unicast business they've had some success opening up different markets for different products that Northside manufactures as well. So what we're seeing with the amount of overlap in terms of the types of capabilities we have in the businesses, the types of products we manufacture, we're absolutely seeing different synergy possibilities. And what we're really excited about is how the leaders of these businesses, we operate in a standalone kind of model where each of the businesses has their own kind of leadership teams and you know, senior leaders, operational leaders, financial people. But we see these business leaders who really are entrepreneurial drivers of the subsidiaries' performance, how they're working together to kind of figure out some of these opportunities to enhance their profitability and operations as well, which is tremendous.
Now, you did mention, I mean, you're buying businesses that you sort of want to see continue operating the way they were before. But is there any kind of integration processes that you have, or what happens when you actually take the keys to one of these businesses? What changes to company?
Yeah, so from a kind of a low-hanging fruit perspective, there are certain things I would call we integrate. For instance, on the insurance, IT, and benefit side of the equation, there's benefits and kind of the scale we have as an overall entity that allows us to take advantage of that scale and oftentimes kind of reduce the cost and improve the quality of the quality of the offerings we're able to give our subsidiaries in those areas. But I think one of the key things that we're forced to address, it comes out of the catalyst that is driving the number of M&A opportunities we have in the business, is that the owners of these businesses are really at the age and stage of their careers where they're looking to dial back out of the business, right? And so one of the key things we are highly focused on as we acquire these businesses, for the most part, is the need to transition leadership. And so that is something that, what we typically do in these cases is we typically have about a 1-year transition period for the existing leadership, who's oftentimes the vendor of the business, that they agree to stay on for that period of time as we bring in new leadership to take over from the business from them, learn from them, kind of ensure that knowledge and goodwill of the business that's so oftentimes in that owner vendor's head is actually left in the business and transitioned into the business, right? That really is a critical thing. And so that's something that we see change over time, typically with the senior leader first, kind of that president type of person in the business is something we typically see a change in once we've acquired a business over time. But we also have a situation like the last one we did with IHT, where the vendors, the two vendors of that business had agreed to stay on for 3 years post acquisition. They wanted to continue this growth trajectory that they put this business on. So that, I think, each opportunity looks slightly different, but leadership transition is something we typically face, which then, really helps what we call realign these businesses more from where they have been operating, which has been more of a sustained success mode, into more of an accelerated growth mode. I think the age and stage these vendors are typically at is, doesn't push them to take the types of risks that, or to really push the business to see what type of potential it has, right? The business produces a certain amount of earnings and income that provide a very, very comfortable lifestyle for these vendors who have worked really hard to put the businesses into that type of position. And it's something they're not necessarily looking to take a risk around, whereas we come in and we want to work to really work with them to kind of preserve the legacy that they've built there, but then build on it to realign those businesses more to accelerated growth through things like enhancing their distribution capabilities or building their distribution networks, focusing on operational efficiency, helping them out on the kind of the people management side of the equation. A few of these different areas that can actually really have meaningful impact on the overall operations and profitability of these businesses and create a return for our shareholders.
Yeah, makes a lot of sense. What do you see as a comfortable deal cadence? Like how many deals do you feel comfortable doing per year, if you can sort of pick a number?
So we did 5 acquisitions in about 465 days. So we were on a 1 every 77-day pace there for a little bit of time. So that was a pretty significant pace, and I can tell you that there's no shortage of opportunities for that type of pace to continue. So what we're really focused on is building the capacity of the team to both be able to handle the M&A elements of the deal flow, but also to handle kind of the integration elements of the deal flow. And so we've recently added a number of people to our team. We've added an additional resource on the M&A side of the equation to help support our overall diligence elements of our deal flow. We're adding some operational people. We just had a head of our manufacturing head start in our business, an individual that's going to really be focused on helping identify operational efficiency opportunities across our subsidiaries that joined our team as well. And there'll be some more of these types of folks that we add to help build our capacity to take on more opportunities, given the pace and cadence of deal flow, incoming deal flow opportunities. We want to be able to take advantage of those opportunities that are in front of us, while at the same time kind of creating value for our shareholders through, you know, kind of the yards after catch element of operating the business more effectively after we acquire them.
And but like, is there a way of sort of substantiating kind of the balance sheet capability that you have? Like, how many more deals, or what kind of revenue, or pick a number, a metric? How do we determine kind of how much more you can take on right now?
Yeah, so you know, I think there's a certain pace at which, you know, we are looking to grow our business. You know, I think what we've done, you know, we built our business up to just under a $30 million pro forma EBITDA business. You know, our 2022 EBITDA was $13.7 million. So we've more than doubled the business here over the past past number of months. Obviously, we're 7 months, or just 8 months deep in the year, and you can tell the type of pace that we're on. So, you know, what we've created is capacity. We just announced an increase in our acquisition line of credit to $25 million. The largest deal we have ever done was the most recent deal we did at $15.5 million. We have, you know, over $23 million of available capacity on our lines. So we have the funding in place to do any deal we've done up to this point. So and that's an important position we want to put ourselves in after each of the deals we do. And so I think that's, you know, that means that, you know, to the capital is available to do more. You know, I think what the type of pace we'd like to see ourselves on is you know, acquiring a certain level of our previous year's EBITDA in any given year. And that becomes kind of a bottom line element of the amount we'd want to add. And so, you know, if you think about kind of a quarter of the previous year's EBITDA being the amount of business we want to, amount of EBITDA we want to add on a next year basis, I think that's kind of how we think about the pace at which we want to grow. And you know, but we'll be opportunistic if there's additional opportunities we're seeing, and we've built our financial capacity to the point where we can take on more. You know, and it's an acquisition that we believe can generate the type of return profile we're looking for in the business. We want to be in a position to pursue it.
Now, you just said that the last acquisition was the largest you've done to date. Do you foresee sort of bigger deals, these type of size deals, or, you know, like, to sort of move the needle, do you have to look at bigger and bigger deals?
Yeah, I think there's tremendous opportunity in what I'll call the $2 to $5 million EBITDA space for us to continue to acquire at that level. Now, we are seeing more deals, you know, towards the higher, you know, the larger end of that scale. But what I think you see with those businesses is, you know, we're developing some competency around that size of business, even in terms of how we integrate them and how we can help support them and create that organic growth post acquisition, right? And so, you know, I think the competency that we're building around that is important, but also, you know, the level of competition around those types of deals. Typically, they fly somewhat below the radar. You know, our ability to have the financing capacity to acquire these businesses with cash, right? You know, we say the minimum of 10% is in stock, but that means 90% of what we're paying for these businesses is in cash. We have the available and the strength in our balance sheet to be able to fund those deals at any given time. We did you know, we have great support from the investment banks as well. We did a bought deal equity raise in April of this year to help us fund the 3 acquisitions we did in April of 2023. We also have really good shareholder support. You know, we have a really large, our largest shareholder is a group called Wartaw Capital Advisors based out of Toronto. They're a investor that's demonstrated a tremendous track record of performance over time, and so they own about 15% of the business. And when they helped us fund the ACR acquisition, the UK based fireplace business at the end of 2022. And as part of that, they agreed to an investor rights agreement, which allows them to continue to maintain their ownership interest at that 15% level. And so and they've been very supportive. They participated in our last equity round and really provided a backstop to that deal, which helped, you know, support the deal on an overall basis. And so our ability to access capital, both through the equity markets and the debt markets, really differentiates us in that $2 to $5 million space as well. And so, there's lots of models out there where people have grown incredible scale in their businesses by continuing to layer on these types of businesses. And so building our capabilities to both integrate and organize ourselves in a way that allows us to continue to do that at an accelerated pace is something we're really focused on doing.
Mm-hmm. And in that range that you talked about, what does the typical competing buyer look like? Is it PE, or is that a little too small for PE, or is it individuals? What do you see out there?
Yeah, so there'll be times where we see strategics that are competing for these businesses. We'll see traditional private equity competing for these businesses. We see search funds that are competing for these businesses. And so it's a range of individuals that we compete against. But what we really try to move towards is to move into exclusivity agreements with potential vendors as early as possible as we can in the process. And that's really on the back of the track record we built of paying kind of, I'll call it, reasonable and fair multiples for the businesses we buy, but delivering on our promise to these owners of operating their business in a way that preserves and builds on their legacy. I think that really is the business model element of kind of buying, building, and holding these businesses for the long term, where employees do keep their jobs and the employees do see the benefit of being part of a larger organization. All these types of things are really meaningful to the vendors we're talking to, and our consistency around doing what we say we're going to do around that element of the business is really critical in terms of effectively competing for these businesses or putting forward a case that allows them to say, hey, this is the type of vendor I want to sell my business to. And that's more important to me than extracting every last penny out of the sale of these businesses. So I want to move forward with those guys. That's, there's a huge amount of relationship work that goes into positioning a deal to have that type of outcome. But then, post acquisition, it's really critical that we deliver on what we say we're going to do to continue to build trust. And then what I call create apostles out of those vendors. I want those vendors to be talking to the next potential vendor to say, hey, well, this is a great group of people to be a part of. You really should consider selling your business to those guys. And I think that's the type of momentum we see being created in the organization already, which I'm tremendously excited about and thrilled about, because that really is there's elements of character that are part of that, right?
Yeah, I wear a hat of director of another company, and I can attest to that. It's not always about the money; it really is about the legacy and the sort of the people you leave behind. So I agree with you there. So we've kind of talked about a lot of things that have gone right, but what if anything have you learned? Like what has kind of gone wrong, or maybe an acquisition that didn't work out the way you expected it out of the gate? What can go wrong in this?
Yeah, for sure. I mean, we've definitely experienced challenges with different types of investments we've made. I think for us, timing of acquisition is something that has challenged. We bought a business called Northside immediately prior to COVID, and was almost immediately into the teeth of COVID, and that was a real challenge for the business. There was a contract that they had entered into, which was proving challenging for them to deliver on as well. And so there was a pretty substantial rebuild of that business that had to be undertaken kind of post acquisition, which really stretched and challenged the business and really helped us kind of refine some of our decision-making process around the types of businesses that we look at as well. I think what's exciting about that business is that the trajectory of that business has completely shifted, and they have some really exciting financial results that we're seeing out of that business currently. But that I think what it illustrates is when you have an acquisition that you're almost immediately challenged by, that can have a really significant negative impact on the overall business model. I think what we need to have a strong level of discipline around in the organization is a few things. Number one, being very diligent around the types of businesses we acquire. I think these businesses that generate what we call specialty product margin types of businesses that operate in niches where they have some level of differentiated advantage in the type of product they produce is really critical to help support the type of moat that protects the business from challenges. And so we're very highly focused on finding those types of businesses that have that type of capability or that type of setup. And what I can say is that there is a tremendous amount of businesses that are for sale in the market that have that type of characteristic. So that's exciting for us to see. So that's one element, buying business as well. The second element is our capital structure, ensuring that we don't put ourselves in a position to be over levered. And, you know, I think where we're sitting at currently, we're about 1.75 times debt to EBITDA. You know, we're in a really strong position financially. And I think our ability to access the equity markets and have the type of supporting shareholders we have helps support ongoing strength in our balance sheet as well. And so that's really critical, because that's another way you can really hurt yourself in this model. And then the third element is just managing the dividend level. You know, we want to have a sustainable and growing dividend. That's something we frequently talk about in these types of calls with investors. And you know, as we do accretive deals that help boost our financial metrics per share, that definitely supports growth in our dividend per share as well. And making sure we're really disciplined to maintain our level of payout ratio within kind of the targeted level that we have is really critical. And then I think if we do that, you know, our investors benefit both from that story of growth and yield, like I mentioned earlier, where they have the tremendous support of the income from the dividend, while also being part of an organization that's seeing the type of growth opportunities our organization is facing. So those are three critical areas for us to focus on to make sure we're maintaining the strength of our overall organization.
What is that, the sort of range of dividend payout that you guys are looking to maintain?
Yeah, so we had in Q1 2023, we had a 58% payout ratio, and that's as a percentage of free cash flow less maintenance capex. So, and then we obviously announced a dividend increase in June off the back of those results. So you know, I think, you know, we're the way we think about that is we really are not, we want the most if you look at it from a cumulative payout ratio perspective over time, we've been up to around 75% on a cumulative payout ratio basis. And I think that kind of forms the upper end of where we would want to be. But, you know, obviously somewhere north of that 58% up to that 75% is kind of the range we want to fit in. I mean, the whole business model is set up to be able to allocate capital towards paying dividends. You know, when you think about the types of businesses we acquire, which produce, you know, a certain level of recurring streams of revenue. I mean, it's not software licensing recurring streams of revenue, but you know, it's you know, fairly highly recurring streams of revenue through the distribution networks that we have in place, dealer networks, you know, those types of things that our businesses utilize. So that's an element of it. The low level of capital intensity around, you know, the businesses. You know, we have less than 2% maintenance capex, for instance, in our businesses that we have to reinvest to keep the plant and equipment operating. You know, we have some really asset light businesses in our portfolio. Like, for instance, Unicast utilizes all third-party manufacturing to manufacture the wear parts that they produce for their clients. They own the designs and IP around the products they manufacture, but they get third parties to manufacture those products. And so we have extremely low levels of capital intensity. It's the same thing with ACR that utilizes third parties to manufacture their product as well. So, you know, if we have the IP protection in place that gives us comfort around that, that's an extremely asset light way of building the business, all of which helps support allocation of capital towards the dividend. And then our capital structure is the same thing as well. You know, the debt we've used to fund deals is housed in a interest-only term debt facility that we have in place with CWB, where we service the debt, but it's a non-amortizing piece of term debt that also allows us to direct our cash flow towards paying the dividend. And so all of those structural setups, you know, are focused on allowing us to you know, allocate the capital as we do in the business, which gives us comfort around the payout ratio levels I talked about earlier.
Right. You mentioned that every deal you do, 10% stock goes to the old owners. Do you put any restrictions around that? Are they free to sell the minute they get it, or is there some sort of escrow provision?
Yeah. So what we have with that is those shares vest over a 3-year period. So a third, 1, 2, and 3 year intervals. So it takes 3 years for those shares to vest. And so there is some restriction with respect to them selling those shares over those time periods.
Now, the stock's had a great run over the last couple of weeks here since the announcement of the new deal. Maybe give us a sense of, are you getting more phone calls from investors? Are you getting, you know, interest from institutional investors? I know Donville Kent came out recently and said some nice things about you guys. I'm sure there's a few others. What's sort of happening in the capital market side of the world?
Yeah, I think, you know, I would say the there's been a couple material changes, I guess, that have occurred with respect to our access to capital over the last 10 months or so. And I think the fundamental one major change was the investment by Wartaw Capital Advisors in our program in September of 2022. Their reputation and kind of their standing on the street, so to speak, in the capital markets world opened up a bunch of people's eyes to us as a possibility of being more, call it institutional ready. And on the back of that, what happened is there was a bunch of renewed interest from a variety of investment banks, as an example, which resulted in us kind of picking up research coverage from a few different parties. We have research from 8 Capital, Cormark, and Beacon Securities at this point in time, and I think that gives a sense of kind of their level of interest in us as an organization also. So that was material, and I think as we had people besides Rick Torriero, our CFO, and myself telling the story, we saw the story gain a little more wind as well. And so people read those reports and kind of had a better sense of understanding of what we were doing. And I think also the research analysts did a really good job of kind of painting the picture around the growth side of the story, around the types of acquisition opportunities that are out there, around the fact that we traded an extremely low forward-looking EBITDA multiple, even though obviously yield has been a big part of our valuation story, plus kind of historical trailing EBITDA, and an EBITDA multiple has been a big part of our valuation story in the past as well. But those guys did a good job of painting a picture of the type of growth potential that's out there, and so that helped our business take off as well. And then which resulted in us being able to do a bought deal. And I guess at the size of business we were when we did that bought deal in April of this year, that was a pretty material outcome. It was 3 weeks after SVB as well, and we had a really strong support from the capital markets that was demonstrated through that bought deal, which was exciting. There's a lot of positive momentum. We are part of the TSX Venture 50, so one of the 50 best performing TSX.V stocks in 2022. We've done a number of dividend increases, which obviously has supported our story, and this kind of additional perspective and interest from the capital markets and institutional investors. We have a long ways to go. We'd be somewhere in the neighborhood of 20% in institutional investor ownership at this point in time. But that definitely is something that's been a bit of a game changer in terms of propelling us in the capital markets and building our story there. And we have great support from folks like Don Volkent, who are investors and who are telling a good story around our name, is for sure, which is tremendous.
Fantastic. As us investors looking from the outside, what do you think are the key either catalysts or metrics that we should pay the most attention to really understand if you guys are continuing to sort of hit your stride?
Yeah, I think I would really focus it's where our focus is, and I guess I would encourage investors to look at the same thing, and that's our per share financial metrics. If we're able to continue to drive growth in our revenue, EBITDA, and free cash flow less capex per share issued, that is a really important. It's how we think about acquisitions. We won't do deals that we don't think will increase those per share metrics, i.e., we won't do non-accretive deals. We need to be doing accretive deals, and then we need to be executing around our organic growth strategies as well. If we are doing that, we will create equity value because those per share metrics will continue to grow. So I think those are important metrics for our shareholders to be focused on. Obviously, watching the dividend payout ratio is something that we started disclosing that at the end of 2022, and I think that's an important metric for people to be aware of as well. And then the leverage ratio, we're sitting at a 1.75 times, like I mentioned earlier, and so we have a really strong balance sheet with a disciplined payout ratio with improving per share financial metrics, all of which creates a really positive story and momentum for shareholders and value creation for shareholders.
And we covered a lot today. Jeff, is there anything that we missed, or is there any key takeaway you want to make sure everybody walks away with today?
Yeah, I mean, I think what we're doing is we're executing on our strategy to acquire successful manufacturing business. 6 acquisitions in 15 months is a pretty substantial pace, like we talked about earlier, but that's really what we're focused on driving. We have an ongoing strong and growing acquisition pipeline as well, because there's a tremendous number of opportunities on the back of this demographic wave of owners looking to sell their businesses. We see strong demand across our portfolio of businesses as well, and so pleased with the organic growth we're experiencing, and really looking to optimize our operations to enhance our margins as well. You know, we're deploying capital into our subsidiaries. We spent in the last 24 months, we put, you know, over $2 million of growth capex into our businesses. And then, you know, through that, you know, our subsidiaries are generating cash that we're using to grow our dividend with the 2 dividend increases we've already announced in 2023 as well. And so that, plus our balance sheet flexibility and support of shareholders, like I talked about earlier, including, you know, what we've seen in terms of our share price performance around, you know, including the TSX Venture 50 participation, really gives us a lot of confidence in the long-term fundamentals of our business, and a lot of excitement about the growth trajectory of our business into the future. So I really appreciate everybody taking the time to listen today, and hope it's been informative and helpful for everybody on the call here.
It certainly has been for me. I got to say, I mean, you guys are smack in the middle of a trend or a demographic shift that you mentioned that we identified about a year ago, and I couldn't agree with you more. I think you guys are really well positioned for this massive wealth transfer that we're seeing, and I think you guys are doing it right. I wish I had found you guys a lot earlier, but I'll take what I can get. But I really want to thank you for the time today. This has been great. I certainly appreciate it, and hopefully everybody else that was listening appreciates it. And we look forward to catching up with you in the future here as well. So Jeff, thank you for joining us. We've been speaking with CEO Jeff Schellenberg. Decisive Dividend, symbol on the TSX is DE. If you want to find out any more, just either reach out to ourselves or you can reach out to Jeff. Jeff, one last time, thanks for joining us today.
Thanks, everybody.